Find a company that is just absolutely firing on all cylinders, but when you look at its stock price, it's just tanking. Well, today we're going to dig into exactly why that happens and figure out what really separates a great business from a great stock. I mean, that's the big mystery, right? A company can be doing everything right, getting straight A's across the board, and somehow the market still gives it a failing grade. It feels totally illogical, but you know what? The reason is actually pretty simple, and it has almost nothing to do with how the company did in the past. So just picture this. You've done the work, you've spent hours doing the research, and you find it, the one. It looks like the perfect company. The financials are amazing, the profits are growing, they're expanding everywhere. You're thinking, this is a sure thing. And then this happens, a gut-wrenching 25% drop that just seems to come out of absolutely nowhere. It feels like all that good news, all your hard work, just got completely ignored. And this is the exact moment where most people panic. But what if I told you it wasn't random at all? What if it was actually predictable? Okay, so this right here, this is probably the single most important concept to really get. The stock market isn't a history book. It doesn't really care about rewarding a company for what it already did. You got to think of it more like a giant forward-looking betting machine. Every single price is a bet on what's going to happen next. Yeah, see, every stock price is basically telling a story. And that story already includes all the known good news. The growth everyone expects, the profits they're planning on. The market doesn't pay you for what it already knows. It moves based on surprises, on any changes to that future story. And here's where we get to the expectation gap. Let's say the market has priced in absolute perfection. They're expecting 40% growth. Then the company comes out and delivers a fantastic, absolutely impressive 30% growth. Now, objectively, that's great, but compared to what everyone expected, it's a disappointment. And that's why the stock can fall. So now that we know it's all about expectations, let's break down the 4 specific reasons why a fantastic business can end up being a stumbling stock.
All right, reason number 1 is a term you'll hear thrown around a lot: valuation compression. Now that sounds super technical, I know, but the idea is actually really simple. It's all about how much people are willing to pay for a company's success at any given moment.
And to get this, we need to talk about the PE ratio. Put simply, it's just the price of the stock divided by its earnings. So a high PE means investors are willing to pay a really high price for every single dollar of profit, usually because they're betting on massive growth down the road. So you can think of that high PE ratio as this rocket ship that's just fueled by pure optimism. For a while, investors are totally happy paying, say, 40 times what the company earns. But if that optimism starts to fade even just a little, that valuation can deflate like a popped balloon, dropping to maybe 25 times earnings. The multiple itself has compressed. And here is the absolutely wild part. This can happen even while the company is making more money than it ever has before. So the business is improving, profits are actually going up, but the stock price goes down. How? Well, it's because that 20% increase in profit was completely overshadowed by a 40% drop in what people were willing to pay for it. That right there is valuation compression in action. It's an incredibly powerful force. But you know, sometimes this compression isn't just about how investors are feeling. It can be driven by these huge economy-wide forces. And maybe the biggest one of all, interest rates. So here's the deal. When interest rates go up, a dollar you can earn safely in the bank today suddenly becomes way more attractive. And that makes a risky dollar of profit that a company might earn 5 years from now look a lot less valuable by comparison. We call this discounting, and it hits those high-growth stocks the hardest, squeezing their valuations all across the market. But beyond all the hard numbers and the math, there's another force at play. It's much harder to measure, but believe me, it is just as powerful. Plain old human psychology. This gets at the danger of what we call an overcrowded trade. Just imagine everyone is already packed onto one side of a boat. The stock is so popular, so hyped, that pretty much everyone who was ever going to buy it has already bought it. There's just no new money left to push the price any higher. So now the boat is totally off balance, and the slightest bit of bad news can cause a panic, sending everyone scrambling to the other side at once. And finally, reason 4. There are times when it's not the company's fault. It's not even nervous investors. Sometimes the entire economic ocean just gets really, really rough. You know, a sudden fear of a recession, or a big shift where money pours out of tech stocks and into energy stocks, or new government regulations. Any of these big macro storms can swamp even the most well-built company, pulling its stock down no matter how well it's actually performing. Okay, so we get the problem now. The big question is, how do we react? This is where we learn to separate panic from strategy. It's about changing your mindset so you can see a potential opportunity where everybody else just sees fear. This right here is the critical fork in the road. The emotional investor sees a falling price and immediately hits the sell button out of fear. But the strategic investor, they pause. They get curious. They see that price drop not as a final judgment, but as a new piece of information that they need to understand. So what questions do you ask? Well, you can start with a simple checklist like this one. First, look at the engine of the business. Do the company's earnings fundamentally break, or did they just miss a crazy high target? Second, follow the money. Did their cash flow totally collapse? Third, check the foundation. Did they suddenly take on a bunch of dangerous debt? If the answer to these is no, then you ask the big one. Is the business still great, but the story the market was telling about it was just a little too good to be true?
And, that really brings us to the ultimate lesson here. The entire game of long-term investing pretty much boils down to this one single crucial skill.
Just let that sink in for a second. The business is the thing that actually produces value. The valuation, that's just what people are willing to pay for it in a specific moment. A real, lasting advantage comes from truly understanding the business and then taking advantage of the wild, irrational swings in its price. And really, that's the question I want to leave you with. When you look at the things you own, ask yourself, did I buy a piece of a wonderful, durable business? Or did I just get caught up in a popular story and a really high price tag? Because honestly, the answer to that question